Repo is like the pawn shop of Wall Street. If you're approaching retirement, here's one system you've probably never heard of, but it directly affects how expensive your future loans will be and how safe your investment withdrawals really are. Imagine Wall Street has a massive pawn shop, not for guitars or wedding rings, but for treasuries. Every night, big banks walk in, hand over treasuries, and walk out with cash. They agree to buy them back the next day. That's a repurchase agreement or repo. This financial pawn shop moves $4 trillion a day. It's how banks get cash, not once a year, but every night. It's how they fund mortgages, business loans, credit markets. But here's the catch. If too many players rush in at once, or if the shop runs short on cash, it raises the cost of borrowing instantly, and that pushes up interest rates across the board for mortgages, credit lines, and yes, even the long term bonds inside your retirement account. So, how does this touch retirement? Retirees are net withdrawers. That means you're no longer contributing to the market, you're drawing from it. Your income depends on the value of the assets inside IRAs, 401ks, brokerage accounts. If liquidity dries up, even temporarily, markets get volatile. Long bonds drop, stocks wobble, and you're forced to decide, do I sell in the dip? Do I delay withdrawals? Do I pay unexpected taxes just to rebalance? This happened in 2020. It almost happened in 2019. And with the Fed pulling liquidity and the Treasury flooding the system with short term debt, the pawn shop is getting crowded again. That's why some near retirees don't leave everything inside this fragile flow. They carve out pieces of their wealth into guaranteed income streams from insurance contracts or annuities that don't rely on repos staying smooth. It's not about beating the market, it's about staying out of the forced selling when the system starts shaking. Think of it like this: if 90% of your net worth is inside Wall Street's bloodstream and the heart skips a beat, what happens to your lifestyle? Where does your income come from that month? So, yes, repo is boring, invisible, and technical, but for someone planning retirement, it's the system that decides whether you draw cash with confidence or get hit by market turbulence just when you need stability the most. And like any pawn shop, when too many people show up desperate, the deals get worse. So don't retire into uncertainty. Build income streams that live outside the pawn shop. Because in retirement, the worst time to worry about liquidity is when you actually need it.